Benjamin Graham, known as the father of value investing, laid the foundation for modern financial analysis and investment strategy. His techniques and principles have influenced generations of investors, including the legendary Warren Buffett. But how did Graham make his first $1 million? This journey, marked by keen intellect, rigorous analysis, and an unwavering commitment to his principles, offers invaluable lessons for anyone looking to build wealth through investing. In this video, we'll explore the steps Graham took to reach this milestone, providing insights and inspiration for your own investment journey. The early years, building a knowledge base. Benjamin Graham was born in 1894 in London, but his family moved to New York when he was a young child. Growing up, Graham was a brilliant student and earned a scholarship to Columbia University, where he graduated at the top of his class. His academic prowess earned him offers from several departments at Columbia to become an instructor, but Graham chose to dive into the world of finance instead. He started his career on Wall Street in 1914, just before World War I, working as a clerk at a bond trading firm called Neuberger, Henderson, and Loeb. This period was crucial for Graham, as he began to understand the mechanics of the market and the importance of thorough analysis, developing the value investing philosophy. Graham's first significant financial success came from his analytical approach to investing, which emphasized the intrinsic value of a company rather than market speculation. During the 1920s, he started to refine his investment strategy, focusing on buying undervalued stocks with a margin of safety, a principle that became a cornerstone of his investing philosophy. Quote, "The intelligent investor is a realist who sells to optimists and buys from pessimists." Graham's philosophy was based on the idea that the market often misprices stocks in the short term, but they will reflect their true value over the long term. This approach required patience, discipline, and a deep understanding of financial statements. The crucial investment, Northern Pipeline. One of Graham's first major successes came from an investment in the Northern Pipeline Company, a subsidiary of the Standard Oil Company. In the early 1920s, Northern Pipeline was trading at a price that implied it was undervalued compared to its assets and earnings. Graham discovered that the company had substantial liquid assets that were not reflected in its stock price. He also identified that the company was hoarding these assets rather than distributing them to shareholders. Graham began to buy shares of Northern Pipeline, and his analysis showed that the company had significant cash reserves that, if distributed, would provide a substantial return on investment. He campaigned for the company to distribute these liquid assets to shareholders, eventually succeeding. This move demonstrated his ability to identify undervalued stocks and take action to unlock their true value. Establishing Graham-Newman Corporation. In 1926, Graham partnered with Jerome Newman to establish the Graham-Newman Corporation, an investment fund. This partnership allowed him to apply his investment philosophy on a larger scale. The fund's strategy was to invest in undervalued securities, focusing on companies that had a margin of safety. The timing was fortuitous, as the 1929 stock market crash and subsequent Great Depression provided numerous opportunities to buy undervalued stocks. Graham's disciplined approach and thorough analysis allowed the fund to not only survive, but thrive during this tumultuous period. Quote, "The essence of investment management is the management of risks, not the management of returns. The road to the first million." By the mid-1930s, Graham's investment strategies had proven immensely successful. He and his partners at Graham-Newman Corporation consistently found undervalued investments, and their disciplined approach paid off. One of their significant investments was in the undervalued bonds and stocks of companies that were in bankruptcy or reorganization, which often sold for pennies on the dollar, but had intrinsic value far exceeding their market price. Through these methods, Graham steadily built his wealth. His ability to identify undervalued assets and his commitment to the margin of safety principle were key to his success. By the time he made his first $1 million, Graham had established himself as a leading figure in the world of finance, teaching and writing, sharing his knowledge. After achieving significant financial success, Graham turned to teaching and writing to share his investment philosophy with others. His seminal work, Security Analysis, co-authored with David Dodd in 1934, became a cornerstone text for investors. In 1949, he published The Intelligent Investor, which distilled his investment principles into accessible language. Quote, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." Graham's commitment to education ensured that his principles would influence future generations of investors. His teachings emphasize the importance of research, patience, and the margin of safety, principles that remain relevant today. Conclusion: Benjamin Graham's journey to his first $1 million was marked by a dedication to rigorous analysis, a commitment to value investing, and a deep understanding of market dynamics. His story serves as a powerful reminder that success in investing is not about quick wins, but about consistent, informed decisions based on sound principles. If you found this video helpful, please like and subscribe for more investing insights. Stay tuned for tips and strategies to achieve your financial goals, and check out our other videos on the channel. Thanks for watching. Raise your IQ with cutting-edge info, insights, and analysis. Visit and subscribe for free at the link below.